And share the screen. All right. We talked a few weeks ago about income, what constitutes income. At that time, we talked briefly around tax-free fringe benefits. We're going to go into deeper detail on that, along with some Affordable Care Act issues tonight. So the things we want to talk about, we've already spent a class on housing allowance, so I won't talk about it tonight. Income tax, it is not subject, it is only valid for income tax purposes. It gets added back to income. It's tax-free for income tax purposes, not for self-employment tax purposes. Gifts we talked about. The gift is based on the intent of the donor, so you could have some gifts that were tax-free to you. If your employer, in fact, any employer covered by U.S. tax law, can pay group term life insurance premiums for their employees up to $50,000, and it be a tax-free fringe benefit to the employees. Scholarships, if they granted you scholarships. At one time, my dad worked for Alabama Christian College, and they granted his children scholarships there. So scholarships, whether it's because of their relationship, teaching relationship or not, generally scholarships are non-taxable income. Employer paid health insurance premiums. If your employer pays health insurance premiums for you, that in most cases, and we'll talk about a few exceptions to that, but in most cases will be tax-free. If you are attending a place and get a reduction in tuition because of some relationship there, then that tuition reduction would be a tax-free fringe benefit. If you are lodging for the employer's benefit, that would generally be tax-free income. We mentioned before the educational assistance. A company and employer can pay up to $5,250 a year for college cost for an employee, and it not be taxable income to them. And that number, by the way, has been set for many years, and the way college costs have gone up tremendously over the last few years, that's not as good a break as it used to be, because $5,250 doesn't pay near as much as it used to for a college bill. Employer provided child care, providing that they do it on a non-discriminatory basis, is tax-free fringe benefit. And then a subject we call de minimis fringe benefits. De minimis fringe benefits are things like an occasional use of a copier or a printer or something, holiday gifts of non-cash property with low fair market value, a turkey, a basket of fruit, or something like that. Coffee or soft drinks furnished to the employee. If the employer has a coffee maker and drink coffee throughout the day, they don't track how many cups you drink and charge you additional income for it. Local phone calls, and in reality, that's mainly because, as a general rule, local phone calls were not charged for, but now with cell phone calling and Wi-Fi calling and voice over IP protocol, it may be that as long as you don't have to pay, the employer doesn't have to pay for a long distance call. Even long distance calls could be a de minimis fringe benefit. Another item there is subscriptions to professional publications. So if the church wanted to buy you a subscription to some, I don't know a good example, Gospel Advocate or Firm Fund or something like that, that can be a de minimis fringe benefit. We talked briefly about meals or lodging. If they're furnished for the benefit of the employer, would be income tax-free, but it would be taxable for self-employment tax purposes. We briefly talked about that employer-provided educational assistance at $5,250 a year. Employer-provided dependent care, as long as it was non-discriminatory, that would be non-taxable or tax-free. Premiums for health insurance for employees and their family paid directly to the insurance provider are tax-free. If they pay the premiums as a reimbursement to you, they are tax-free if they ask you to provide proof of the payment. They can be tax-free. Tax-free status depends on the church having a written plan, and that truly means a plan in writing. I think we've got, yeah. A written plan must incorporate a recorded commitment in the minutes, a commitment to certain rules and regulations governing payment, i.e. it has to be, you have to provide proof of payment. It has to be done within certain amounts of time. If they overpay a reimbursement, you have to repay that, etc. Just a variety of rules and regulations concerning that payment. A communication of the rules to the employees as a definite policy prior to any payment. It has to be called an accident or a health plan, and it has to be operated on a consistent basis. It's not hard to develop one of these and put it into the minutes and, get it legitimate to be qualified as a written plan so that any health insurance benefit you get is non-taxable to you. But if they give you a 1099 instead of a W-2, they consider you to be self-employed. Any health insurance premiums paid by the church would be taxable income. And as such, they should be included in the amount shown on the 1099. The other issue we talked about there on that 1099 is, how are they going to show housing allowance? If they net it out, are they going to give you something that says how much it was so you know what to do with it? There are a lot of issues around that. If it did become income to you, then it would qualify for deduction on the front of Form 1040. Self-employed health insurance or medical insurance is a deduction on the front side of the 1040. Has been in the past on 2016 returns, was on line 29. I believe it's still there, although it's not that important which line it's on. You'd know what to look for to find it. A church plan. We talked about a church plan briefly earlier. A church plan is a plan maintained for the employees by a church or convention of churches that are exempt from income tax under 501c3 of the code. Health insurance provided via a church plan is a non-taxable fringe benefit. A church plan is by statute exempt from the discrimination rules. A lot of employers cannot discriminate against certain employees or certain classes of employees in their plans. It has to generally be open to everybody in the same manner. But for a church, they are allowed to be exempt from the discrimination rules. So that church plan would have to be written, as we saw earlier, would have to be written, and any premiums that were paid by the church would be tax-free. We also will talk about a church plan when we talk about retirement accounts, potential retirement accounts. Church plans can be qualified retirement vehicles as well. Under the Affordable Care Act, there is a definition of a small employer as someone that has less than 25 full-time equivalent employees. who earn on average less than $50,000 a year and who pay premiums for health insurance under a qualifying arrangement. As a general rule, the Affordable Care Act, well, we'll get a little more into Affordable Care Act in a minute. Let's talk about what I said earlier, that as a general rule, if they pay you reimbursement or pay you direct the health insurance premiums, those would be tax-free. In order for that to happen, they have to be paid under what is called a Section 125 cafeteria plan. Once again, these are not hard to set up, and most people you deal with that are going to sell the insurance are going to be familiar enough with it that they can make sure you get it set up right. You can, under a Section 125 plan, include things like accident and health benefits, health savings accounts, adoption assistance, dependent care assistance, group term life insurance, anything up to $50,000 of coverage. Anything over $50,000 of coverage, the first amount of premium would be up to cover the $50,000 would be tax-free. Any premium they paid for coverage over the $50,000, you would get charged a premium, a minor premium for that. Like say it's a minor premium. You can get the group term life insurance for a tax cost that is minimal compared to what you normally would go out and buy it. So if you wanted to cover it under group term life insurance under a Section 125 cafeteria plan, that would be a very cheap way to buy some group term life insurance that could pay you a lot more than even the $50,000, and it would be minimal cost to get that coverage. All right, back to the Affordable Care Act. In the Affordable Care Act, there is both a personal mandate and an employer mandate. Personal mandate was to have qualifying health insurance coverage effective March 31st, 2014, and continues until now. Congress has not changed that yet. They have talked about it numerous times, especially in the Trump presidency. They've had some great discussions about it, but they have yet to actually do anything about making a change to that. So the personal mandate is in effect, has been in effect since 2014, continues in effect through today. The Act also provides for the possibility of tax subsidies or credits to offset the cost of health insurance coverage. As the law is written, the credit is only available to taxpayers who have qualifying creditable coverage. That's generally interpreted to mean coverage that has been issued through a state exchange. In fact, in 2014, there were two different tax court rulings who came down on exactly opposite sides of that question. In the D.C. Court of Appeals held that a subsidy was only available to taxpayers who purchased through a state exchange, which was exactly the way the law was written. The Fourth Circuit Court held that the subsidy would also be available to taxpayers who purchased coverage through the federal exchange. For those of us who live in a state like Georgia that did not establish a state exchange, and I don't know if Alabama did, I don't know if Missouri did, I don't know, you know. I do know that Georgia did not, and I think about a third of the states did not. But the way the law was written, they would not be eligible for a subsidy, although the federal Fourth Circuit Court held that they would be, and the Supreme Court actually ruled on that and held that sided with the Fourth Circuit, saying that subsidies are available to taxpayers who purchase coverage through the federal exchange. So that's one of those issues where the law being very plainly written, the circuit court in essence overrode what the law says. All All right, we talked briefly earlier about the employer mandate. The Act segregates employers into 4 different size groups based on the number of full-time equivalent employees they have. That defines a full-time equivalent employee as anyone who works an average of 30 hours a week during a year, basically. The 4 categories that are established are less than 2 full-time employees, more than 1 but less than 50, more than 49 but less than 100, and more than 99 full-time employees. So you've got, in essence, the single employer group on the, the 2 to 49, and the 50 to 99, and the 100 and above groups. Those are the 4 groups. And currently, only those upper 2 groups are required to offer health insurance coverage to their employees. From a practical standpoint, when you talk about churches, I don't know of any churches that meet that, having more than 49 full-time equivalent employees. There may be some denominational boards that do that, and as such would be required to offer health insurance, but I'm not aware of any churches that have that many employees. I may just be ignorant here. I don't know. All right, a church which offers qualifying health insurance coverage can also qualify for a refundable credit of payroll taxes paid. Now, think through that for a minute. The minister is not an employee for payroll tax purposes. They are self-employed for payroll tax purposes. So, in order for the church to benefit from this, they would have to have other employees other than the minister that would be subject to payroll tax withholding. That credit is available even though a church does not normally have to file a Form 990, but they would need to file a Form 990 in order to receive the credit that's available. I had a client who was a church, had an employee, had a secretary who was a volunteer position, and they said, if we pay her, then we get a credit for payroll taxes, right? And I said, yes, but you also have to come out of pocket to pay her. So it's, I wouldn't, if she's still willing to be a volunteer and not be paid, just starting to pay her so you can get a credit doesn't necessarily make a lot of sense, because all you're getting the credit for is the payroll taxes. So that, which is maximum 15.3% of what you're paying her. So, to pay somebody to get a credit for 15 cents on the dollar of what you paid her just doesn't make a lot of sense to me. But, so that is available if the church has other employees that are subject to Social Security and Medicare taxes. They can get a credit. They have to file a 990 in order to do that. All right, that's what I had to talk about tonight, unless you've got some questions or comments or issues that you want to deal with.
I do have a question. I've got a couple of them. Under employer-provided educational assistance, is that only like towards a university or a college? Like, a lot of congregations, you get a week for education and so you get a week to go to polishing the pulpit, or a week to go to the Harding lectures or something like that.
Yeah, that 5,250 number would be toward an accredited university or college or something like that. It could even be a 2-year school. Yes, that would be toward that.
Okay.
Now, if as part of your employment agreement, they have terms like, you can take 2 weeks a year or a week a year and attend whatever, let's call it continuing education type situation you want to, like PTP or lectureships or whatever that may be. And if they continue to pay your salary, which that's what they're doing, and if they choose to pay your registration fees or, you know, lodging or meals or whatever while you're there, that's fine. That's not necessarily income to you if they're just reimbursing your expenses while you're on business, in essence. Subject to those issues that we talked about, I believe last week it was, about, you know, if your spouse goes with you and she's not required to be there as a part of the function that's going on, you know, you get to maybe deduct your meals but not her share of the meals. Or, you know, if you drove, then, you know, it'd be different if you flew, whereas she's got a plane ticket, you know, you might not get to deduct. But yeah, those sorts of things are generally just reimbursable expense type things. But if you wanted to go to, you know, you're not that far from Montgomery, so maybe you want to go to Faulkner and take classes for credit at Faulkner, and they agree to pay up to $5,250 a year, that's fine. They can do that. Now, if they paid any more than that, the excess would be income to you.
Okay. Okay. And I had another one. I'm looking back through the slides here.
Okay.
To spark my memory. Well, I got one more, and it has to do with the expense report or an expense account.
Okay.
With an expense account, so at this point, I don't have an expense account.
Uh-huh.
I was to, prior to it coming up for, you know, my review for a raise this year.
Right.
And I was to, prior to that, talk to the elders and say, you know, instead of in lieu of a raise this year, could I have an expense account?
That would be fine. What you cannot do is say, look, y'all agreed to pay me $50,000. Let's cut it to 45 and call 5 of it expense reimbursement account. You can't retroactively or you know, you can't cut your salary and move that over to an expense box. But what you can do is agree with them that an expense, a pot of dollars to reimburse expenses would be beneficial to you, more beneficial than a raise, because in essence, especially under the new tax law where you're not going to get any expense reimbursement as a deductible item, you know, it just makes sense to carve out in lieu of a raise some dollars and put them as an expense bucket that you can get reimbursed against. Just be careful that you don't put too many dollars in there that, and as we talked about earlier, you have to, it needs to be a written plan. It needs to have those criteria about, you know, certain rules and regulations about reimbursement. And we may even have, under the discussion of accountable plan, no, that's not it. That's not it. there are issues out there, and I thought we had a discussion about it, but I don't see it right offhand, where we defined what an accountable plan was and the criteria you had to.
Well, we did go over in class, what was stuff that would be an expense.
Right.
Would be, and what would not. Yes, sir.
Yes, we did, but there are rules about how you set up the reimbursement arrangement such that it qualifies. There are certain rules about it, as we talked here in the earlier slide about. This one, recorded in the minutes, commitment, certain rules and regulations governing payment. So I would just Google accountable plan for IRS purposes or something like that to get an idea as to what things need to be in there. I thought I had some slides on it, but apparently I don't. I know at one time I did, but I don't know what's happened to them. But yeah, and if you can't find anything, let me know, and I'll send you something that can give you those ideas. But it does need to be a written plan, and it does, it makes sense to not get paid things if you're going to have to spend dollars that would be legitimately reimbursable.
Okay.
Yeah, it makes sense to carve out some dollars. Just don't get too gung-ho and not get full reimbursement for it, because then you haven't benefited yourself.
Yes, sir.
Yeah, if you said, I'll do $20,000, but you only spent 10, you hurt yourself as opposed to helping yourself.
Yes, sir.
Yeah.
I have one more quick question. The other day we were talking about the the new tax laws that went into effect for 2018.
Uh-huh.
And I was listening to the State of the Union, and in the State of the Union, Trump said that they had increased the child deductible. But when we were talking the other day, I thought you said that they did away with the child deductible. So that, it was like we're a family of 6, so we're dropping from $28,000 down to $24,000.
Right, and that's, I didn't listen to the State of Union address, so I don't know what he said, but here's what they did. They increased the child tax credit. It used to be $1,000 per child up to age 17 that you could claim a $1,000 per child tax credit, and it phased out at certain dollar limitations. They have increased that to $2,000 per child. So whereas a family of 6, 4 children under, I believe, are all yours under age 17?
Yes, sir.
Okay. So 4 children under age 17 in the past, you would have been eligible for a $4,000 tax credit. Now you're eligible for an $8,000 tax credit. But they did do away with the personal exemption amount in the new tax law. That personal exemption in the past for 16 and 17 was $4,050. So a family of 6 would have $24,300 in personal exemption, and if you took standard deduction, you had $12,700 or something like that in 16 as a standard deduction. So a total of $36,000 or $37,000 between both standard deduction and personal exemption. Well, in 2018, the personal exemption goes away, but the standard deduction moves to $24,000. So you're losing, in essence, $13,000 worth of reduction in taxable income because the personal exemption goes away, but you're picking up another $4,000 worth of child tax credit. So, a $4,000 child tax credit in a 25% tax bracket would be worth would cover in essence $16,000 worth of income.
Okay.
So I don't think you're hurt necessarily, because your children are still young enough that you benefit from it. Now, once that child hits 17, you don't get that tax credit anymore. And I believe they kept that the age 0 to 16 is qualifying for the child tax credit. Okay, let me look real quick here. You sound like you're not too well off.
Yeah, we've in our area, in our congregation, we had last night probably 10 people out with the flu and different sicknesses. So it's hit us in this area. I'm just trying to stay as good as I can.
I understand. I don't see anything in the discussion here about the new law which says they changed any of the rules about the ages. It sounds like the still qualifying child ages and those sorts of things are the same. They did increase the phase-out limitation, so it starts phasing out at $400,000 for married filing joint, so I don't think you'll have a problem there. If you do, let me know, and I'll start preaching down where you're preaching. So,
yeah, we ain't gonna hit that.
They also have begun a $500 credit for qualifying dependents who are not qualifying children. So I don't know if that's, for example, if your mother or your wife's mother was living with you or something like that. I don't know what all's in that. They haven't come out with a lot of information on that yet. But as far as the new law is concerned, yeah, you've got less reduction in taxable income, but with the child tax credit, I think you'll have a bigger benefit from the increase in the child tax credit than the decrease that you have, or the problem you face because of the less, the personal exemption going away.
Okay.
I think you'll come out better off in the long run because of the new tax law.
Okay.
All right. Anything else?
No, sir. That's it.
Okay. Well, I'm going to sign off here and save the video and publish it. And, next week, let's see here. Next week we're covering all our sample tax returns, 4 different situations. So you can try to put together some of these things that we've been talking through and give some real numbers out here that make some sense and help you understand some of the issues we've been facing.
Yes, sir.
All right.
All right. Thank you, sir.
Okay, Justin. We'll see you.
Bye-bye.
Bye.